you all for joining us today. My name is John Chavez, and I am a serial entrepreneur. So not like creating breakfast food, but by creating companies in New Mexico, really to help out, the community, but also to try and create value for our employees, our investors, and the community. So once again, thank you so much. If you have a question, please put it in the chat. Cecilia will be monitoring that. So a little bit about myself. I am the former president of the New Mexico Angels for about 11 years, and I've raised over $20 million for New Mexico companies. Out of those companies, we had some good successes and we had some failures. And that's really the nature of angel investing. I founded 2 venture capital funds, Phase 1 Ventures, $1.8 million fund. We're harvesting the company. We have one company left in that fund, and we're hoping it sells in the next year or two. And NMA Ventures is a $4.2 million catalyst fund, and we have about $800,000 left to invest out of that fund, and then we'll continue to help those companies try and create value. I'm the founder of the New Mexico Startup Factory, and it really is a company that creates other companies using technology from UNM, NASA, Cedars-Sinai, other institutions that have really interesting technology. Ozasta Energy is one of them, T Neuropharma, Inthentica, Ortec, Jeeper G1, and we just started another one called Elroy SPAC. And didn't slow down during the pandemic, started 3 companies, raised $2.16 million in equity, received $1.6 million in grants, and we submitted $3.25 million in grants and are still working on trying to get those grants funded. So one of the things I always like to do is share with the people in the audience who's doing things in New Mexico. And so if you're looking for capital, we have the New Mexico Angels, we have the Arizona Technology Investors, we have the Desert Angels, and you can actually go to the Angel Capital website and see what other type of angel groups are out there. So once again, people that are doing things for the startup community in the angel space. We do have some catalyst funds that are actually out there making investments. NMA Ventures, the Albuquerque ID Fund, the Arrowhead Innovation Fund, which is an investor in the New Mexico Startup Factory. Tramway Ventures, that does a lot of the bio space. And Bluestone Ventures has catalyst money, but has had it for three years, and I don't believe they've done any deals in New Mexico. So might not want to put that one on your list. And then we have some active venture capital funds. And these folks are deploying anywhere from $1 million to $3 million in early seed and early stage ventures, or Series A, Series B. But really nice folks out there, and tell you no if it's not a deal that they fits in within their portfolio or what they want to do with their capital. So a little bit about our agenda today. The topics of the seminar are company valuation and value creation. We're going to talk a little bit about business entities and what are the differences and what will the investors do with each kind of structure. And then we're going to spend a little bit of time on term sheets and actually show you a couple of term sheets so you can see what they feel like. And a term sheet is essentially the communication via a document on what an investor wants to do as far as putting resources into a company. So I'm going to go back a little bit, and if you're a financial person, how do you value companies? And the way it is traditionally done is you look at this formula right here, and it says the value of equity today, a discounted rate, the growth rate, and next period's expected cash flow. And then you say, well, how is the cash flow impacted? Growth rate and the risk associated with cash flows. The higher the growth, the more valuable the cash flow. Higher the risk, the less valuable the cash flow. So quick question. What if you don't have any cash? What if you're not making any sales? And all you're doing is trying to raise money for your prototype, your marketing, you're standing up your team, you're licensing your technology. So this is old school valuation metrics. So this is not old school, but this is what investors do both at established companies and early stage companies. You want to look at the growth. What is the size of the addressable market, the penetration of the product, and how many widgets you can sell and how fast you can sell them, a go-to-market strategy, and then the team. Does the team have the ability and the experience to scale the company? And then there's the risk. You know, there's risk in everything we do today, but in how investors evaluate risk, it's what is the sustainable competitive advantage? Do you have IP? Do you have secret sauce? Do you have something that nobody else can do? Are there customer switching costs? Which means if I sell into a marketplace, what does it cost a customer to go away from their current vendor to me? How dependent is the business on the founder and the employees? Does the business own their own IP? And is there a regulatory risk? Big regulatory risk if you're in the cannabis business is getting a license. So investors look at all these things and decide how they value a company. And then one of the important things that you hear about in early stage, but also established businesses, is what is called unit economics. And what unit economics is what is the margin of when I make a product and sell it into the marketplace. And think about software, think about TurboTax. You know, they build it once and then they sell it millions and millions of times. But they have to have customer service, they have to have other things that are important, but the margin on a software package like TurboTax is about 99% because they build it once and sell it millions and millions of times. There's other fundamentals that you have to support your company with, but that's what is unit economics. So what we're going to talk about is company valuations that don't have cash or don't have cash coming in the door and are looking early stage seed companies. So this is really an art more than a science. You know, you can go on the internet and plug in a bunch of numbers and out pops a valuation. But when investors look at early stage companies to determine a value, they really look at a number of things. But as I roll it up, it's really about the team, the product, how big the market is for the product, the intellectual property, the deal that I'm going to be dealing with. Is it a good deal from an investor perspective? The team, once again, the team is very, very important in early stage companies. And then market comparables. Is there another company that is doing something similar that I could look out and say, well, this company did X, Y, and Z and got to a nice value at the end point. Is this company that's talking to me today going to be that same type of company? So we have public markets. And what's interesting is I did this presentation about 4 years ago up in Santa Fe. And in public markets, every day you can look on the internet and say, what is the valuation of that company? Because they take the amount of outstanding shares, multiply them by the price of the shares, and then that becomes your valuation. So I was going through this morning, and 4 or 5 years ago, Apple was worth $648 billion. Today, $2.43 trillion. IBM, 5 years ago, $141 billion. Today, $128 billion. GM, 37, 79 today. Tesla, 33 billion 4 years ago, 694 billion today. Think about the kind of return you would have gotten on that type of investment. P&M has doubled in 4 years. McDonald's has gone up by $86 billion. Public markets provide public information, so you don't have to guess about what that valuation is. Investors, however, will look at that valuation and say, oh, that's way too much, and maybe sell it short. Or they'll say, I see a lot of promise in IBM. I think it's going to go up in the next 6 months, and put money behind it. So once again, you're getting a lot of information from a lot of people on what are the prospects and the valuation of that particular company. In private market, it's totally different. So private markets, venture capital, angel companies, and private equity are less transparent. You see occasionally information coming up on webs or on the web or press releases about early stage funding. And this is about like 4 years ago. They were valued at $102 million. And that was when they put out a press release. This one called Choice Stream had a private valuation of 67.5 million. They raised 14 million in a Series C kind of financing. In 2021, one of our startup factory companies raised money at less than a $1 million pre-money value. Another one of our startup factory companies raised money at a $4 million pre-money valuation in 2021. And really, it's about what is the investor looking for, what kind of risk are they taking on, and what kind of value are they looking to create with their investment. So the valuation process. Essentially, how angel investors view the valuation process is they come up with that pre-money value. And how do they do that? They look at these things right here. They create a scorecard sometimes, putting a percentage on those. And then they say, it's $3 million. And we're going to put $500,000 in. So you have your pre-money valuation, your investment dollars, and then your post-money company valuation. And in that example, $3 million pre-money, $500,000 investment, so $3.5 million company valuation. And once again, what's going on in the marketplace? So in the last 3 years, the valuation metrics for early stage and seed funding has gone up. And there's a couple reasons. One is there's lots of money out there that is looking for a place to find a return. You know, stock market continues to go up. Is it going to go down? Probably. Real estate's going up. Are you going to be priced out of that market? Interest rates are almost zero. And so people are taking more risk to get a same or a better return than they previously did with other investments. So a couple things are going on. A lot of angel rounds are doing what's called convertible notes, safes, and we'll talk about those in a second, but it's not actually a priced round where they come up with a valuation. And the other thing is that another thing going on is there's a lot of large investors moving onto the early stage and seed space. So they're putting more money into companies and getting more equity when they do a deal. So valuation recap. It's the price that you're willing to pay is the value. A general rule of thumb when valuing a company for funding, the company value must be high enough that the entrepreneur is happy, because you never want an unhappy entrepreneur, but low enough that an investor will write a check. So once again, it's this coming together in a negotiation process about coming up with your value, how much money you're going to put in, and under what terms and conditions. So how do angels do it? Typically, you come up together with a number of angel investors, they discuss it, they work with the entrepreneur, they work with the entrepreneur's attorney, they look at the due diligence package that's been created, background checks of the entrepreneur, market studies, product studies, where's the company in its own life cycle. They try and create a valuation number that attracts investors, and then they come up with a negotiation with the entrepreneur for the final valuation and vis-a-vis a term sheet. and we'll share that information with you in a second. So sometimes angels put together a valuation scorecard, and it all typically adds up to 1. And so you want to say that what's the strength of the management team, size of the opportunity, the product, the technology, competitive environment, marketing. A lot of these early stage seed companies need additional money. So what is my dilution factor? And then other, there's always the other that you want to look at. So when you're talking to a venture capitalist, it is a little bit different. The negotiation for the valuation is a lead venture investor. So typically you have a series of investors that come together to do a large round, whether it be 3, whether it be 10. For smaller rounds, an venture investor will typically do it themselves, but you'll have a lead investor and they'll assist the company in filling out the round. Venture investors ask for a ton more information than angels, just because that's their job. They have to protect their interests, and they have to do that due diligence so it meets what they would call as fiduciary responsibility for the money that they're investing. And then VCs model every aspect of the business: the costs, the pricing, the revenue models, the cap table. I mean, we're working on a deal right now. It's been going on for way too long, and they've modeled everything. And they keep asking for more information. And we're going, time out, write a check or move on to the next deal. And then the negotiation with the entrepreneur is with other venture investors so that you can come up with a deal. Because the goal of working with investors is to get the resources that you need and finalize a deal so that they will invest in your company. So doesn't always work though. And I have an example of where some large institutional investors, T. Rowe Price, Fidelity, don't understand value. And I don't know if you've heard about WeWork, but it was a company that was founded as a quote unquote tech company. But really what they did is they would acquire property and then lease out seats for entrepreneurs or people that needed just a small office space. They would create an environment that hopefully would propel companies and people to success. And they raised $9.8 billion in 9 years. Their final valuation was $45 billion. And according to the Financial Times, which is a newspaper out of London, the company lost $219,000 every hour, every day from March 2018 to March 2019. So their last funding round was about $6 billion at the $45 billion valuation. So what happened? They filed to go public at the expected price was $80 billion. And in the filings, and this is why it blew up, is the wife of the founder picked the next CEO rather than the board. And in the filing, they had a private jet that they purchased for $70 million, and they used it to go on surfing trips. And in the filing, the founder purchased properties and then leased them to the company at favorable terms for the founder. And in the filing, the founder trademarked "we" and then sold it for the company for $6.6 million. So the corporate governance just wasn't there. And when they filed, the thing just fell apart. The last funding round was $5 billion valuation. So the people that put their dollars in at 45 billion free money value were crushed. And now multiple lawsuits have been filed, and they continue this day. So once again, valuation is an art. It's not a science, but you have to do your due diligence to make sure that the corporate structure and the founders are aligned with you as investors. So this is a graph that just shows you, their valuation was really, really low, and it started going up, went down a little bit, and then went way up, and then it went boom, down to 5 million. I was reading that they're looking at raising more money at a $4 billion valuation now. So here's some information on how you put values together from the Angel Capital Association. I will share this presentation with Cecilia, and if you want it, you can reach out to her. Kaufman Foundation, and then Gus 10 rules for startup valuation. So we're going to step into some business primer. So what are in the types of companies, not biotech, SaaS, software, fintech, but what type of companies do investors invest in? The biggest one is a C Corp. And a C Corp is put together with documents from Delaware. Every state you can file for a C Corp. The owners are shareholders and stockholders, so you have a limited liability. You put the money in, and then hopefully, if the company goes bust, no one will come back to you. There's 2 levels of taxation, at the entity level and at the shareholder level. So if you own a P&M stock right now and you get a dividend, they're paying taxes on their corporate income, and then you're paying taxes when they give you a dividend. And there's multiple levels of stock permitted. Series A, B, C, D, E, F, G, L, M, N, O, P. And it allows for different types of stock to have different preferences. And angels and VCs will invest in C Corps. There's an S Corp, won't spend a lot of time, but typically angels and VCs will not invest in C Corps. It just doesn't make a lot of sense. And then limited liability companies, which is essentially a corporation. It limits the liability of the people that are involved in it, but you have to flow the taxes down vis-a-vis a K1. And so they're really a pain in the tush to do, but in New Mexico, it's real easy to create an LLC, and you don't have to do a lot of changes. And so it's a good vehicle. And then if you get going and you start seeing success, you can transform into a C Corp. Once again, profit allocations are taxed, whether the profit is distributed, even though you can put it in your term sheet, they have to distribute some of that money. And then angels and VCs will invest in LLCs. So just common considerations when you're starting a company. What's your expected growth plan? Are you going to need a lot of serious investment? Do a C corporation. Are you going to be looking outside of New Mexico for capital? Start a C Corp. What is your investment goals? Are you going to grant your employees and consultants equity? Will the company be doing business in other states or have offices? And will the company be licensing any technology? So really, it is about what is your goals as a company, and from a fundraising perspective, and how quickly are you going to be moving from needing a little bit of money to needing a lots of money. That's a technical term, lots of money. So you have common stock, and this is typically stock that is sold to family and friends or the first early seed investors. The same preferences, the same ownership, whatever a common stock is, everybody that owns it gets the same deal no matter what. There's no preferences, same rights as the founders and other common stockholders. Sometimes you can negotiate a board seat when you do a common stock deal, but not typically.
John, we have a question.
Sure.
Will angels invest in LLC with an understanding that it will convert into a C Corp?
Yes. That's a preference of an investor, because once again, you want to have that limited liability, but you don't want to have to get a K1. So it really is a function of how much money you're looking to raise and how long you think you're going to need to. LLCs are good because they flow losses down to your investors. They're not so good when you're flowing profits down to them and they're not getting a distribution. So if that, yeah, we say that a lot today. You know, we're going to start as an LLC, but in the future, we'll convert it to a C Corp. Was that the right answer? Okay, so preferred stock. Preferred stock is a preferred above the common. And so a preferred stock is created by the investor depending on what type of deals there. So you can have a preference of a dividend, you can have a liquidation preference, and we'll talk about that. Information rights, a board seat, a right of first refusal. So there's a number of components that you can put in a preferred stock so that you have visibility into the company, but also you have preferences to the common stock if something happens that's either good or bad. If it's good, it means you get, sometimes if you have a preference, you get the first money out and then you share with the common on other things. So, sorry about that. Preferred stock is just really a negotiation perspective and a desire of what the investor wants. And also, from a company perspective, if you're raising money and you're doing a Series A or Series C, it's going to have to be a preferred stock because those type of investors want preferred stock. There's a pre-money valuation in this perspective that, you know, those who have the money make the rules, but it goes back to that negotiation piece. And there is something called a no shop rule, which means when I give you a term sheet, I get 60 days to do a deal with you and you can't go talk to anybody else. And that is binding. Everything else is not binding except for the no shop rule. And we'll walk through a term sheet in just a second. And then convertible debt. These are really easy. Essentially what you're doing is you're just saying, I'm going to loan you money and at a point in the future, you're going to give me equity. And you negotiate on a valuation, you negotiate on an interest rate and a discount into the next round. Convertible debt is really good if you don't want to spend a lot of money on your attorneys. However, right, what's going on in the marketplace is there is a requirement for the valuation conversation because investors put a cap on it. So they'll say, you know, we'll invest $1 million at a $5 million cap. If you raise money at a $10 million valuation, we convert it to $5 million valuation. So once again, they're taking that early risk. So they're asking for more return out of that particular deal. And sometimes you see equity investments in convertible debt in one transaction. It does happen. Other things that happen in a convertible debt round is you convert debt into what's called a priced round. So all sorts of vehicles to get money. So there's something going on in the marketplace. Additionally, it's called a SAFE. And a SAFE agreement is you give me money and in the future, I'll give you equity. And so it's real easy, but from an investor perspective, we steer away from SAFEs because there's no valuation conversation with the entrepreneur. And so 5 years from now, I may put $100 grand into a deal and their valuation is going to, because they've done so good, it's going to be $100 million. My piece of the pie is going to be very, very small for the risk that I took. So there's a lot of these things going on, but the investors are trying to negotiate valuation terms so their early stage investments have some meaningful impact on their portfolio. So I'm going to pause for a second and see if there's any questions before we do a little bit on term sheets. Hi, everyone. It's good to see you. Okay, I'm going to share a couple term sheets for y'all real quick.
Can you go back? I'm going on, taking my mic up. Can you go back to the slide that you had on the 0 to 25 and the 0 to 30? And
Oh,
there
yeah,
was a question I had there, but I didn't see it clear enough to evaluate.
Sure. Give me a quick second.
Yep.
So we're talking about the scorecard.
Right. Of what they might score something for. Yes, this one. Yeah. I guess I didn't understand the distinction between the size of the opportunity and the product. I mean, they seem to be almost the same, at least in our case.
Okay, so think of one evaluation. So actually, how we used to do this at the Angels is we would put an arbitrary value on a company, and let's say $3 million, right? And then what we would do is we would do an evaluation on each one of these things. Oops.
Yep.
Each one of these things and give it a score. And then from that valuation, arbitrary evaluation model, we would either add or subtract. So if you had a really good management team, we'd say, put another $500,000 in there. It's a humongous opportunity, put another $250,000 in there. The product is so early stage, take off $500,000. The competitive environment, if we get this to market, we're going to blow it out of the marketplace. Put another $1 million on there. So that's how you typically do these things. So regarding size of opportunity, think of an iPhone, right? So
is that market? Is that the size of the market or the product and technology? I thought would be the market, but maybe that's where the distinction is.
Different. So let me share with you what a company that we have that we think is really, really cool. So we're creating a antenna that is a cell phone booster that does not require a battery or electricity. You can take it out on a hike, unfold it, and your bars will go up by 1 or 2 points, right? And so the size of that opportunity is humongous because policemen, hunters, hikers, all those folks are going to want to buy it so that when they get out in the field, they can get a better cell phone signal. The product is the antenna. So if everybody could do this, it would be a zero, right? But we have intellectual property from an institution that we own, they own, we licensed it, so no one can come into that particular field. So the product is very different than the size of opportunity. It's really how long is it going to take to develop that product to bring it into market. Biotech, we have another company that is developing a diabetes drug. It's going to take 3 years to get into the clinical trials. And then it's going to take another 5 years to get through the clinical trials. So 8 years before you see any sales of that product. So does that clear up the differentiation?
Yeah. Can I ask one more question related to this? The size of the opportunity of our product is more than your antenna, but the complicate, it's also more complicated technologically than your antenna.
Once again, it's all about thinking about what your valuation is and putting a score on that particular piece and saying, looking at all of these things, putting it together so we can come up with a valuation for your company today if you're looking to raise $500,000 kind of stuff. Because the investor will put a valuation metric on your product if it's early stage, if it's a high risk kind of product.
Okay.
Okay?
Yep, thank you.
Sure. So let me pull up the term sheets for grins and giggles.
There's a few other questions,
Oh, sure.
John. Do you have a preferred form of deal?
You know, I've been a seed investor. I've been a convertible note investor. I've done common stock deals. it really is a function of what is the company doing, the people within the company. So not preferred, I mean, it really is a function of the people and the company.
And then the last question is why C seems like safes. It's from Steve Cordova.
Say that again.
Why C seems like safes.
So a safe is really a convertible note without any interest rate, without any discount, and without any valuation. So it's relatively quick from an entrepreneurial perspective, because I just give you this document and you sign it and give me a check. But there's, from a structural perspective as an investor, I don't know what I'm getting. I don't know if I'm going to get, 1% of the company, 5% of the company, 0.01% of the company. So a safe is essentially just a, we're going to give you the money, talk about it in 2 or 3 years.
And then one more question, and then we'll move on to term sheets.
Okay.
Can you contrast how VCs assess valuation versus strategic buyers?
Oh, great question. No comparison, because strategic buyers are looking for something to fit within their product suite, or we had this conversation with one of our portfolio companies last week. There's 3 reasons why a company would buy another company. The first one is they don't want anyone to get what that particular company has. So they're gonna buy it to keep other players in the marketplace from having that particular product or company. The second thing is it reduces their expenses. And in this situation, it was a software company, and they were, if the company that was looking at buying them, $8 million worth of other software costs would go away. And the third reason is to boost sales. So those are the 3 reasons that people buy other companies. And a strategic is more willing to pay than a venture investor. So great question. Strategic partners, if you can get one real early, it's a beautiful thing to move your company forward in a very meaningful way. So I'm going to share a screen here. So this is a term sheet, okay? And these come in all sizes, shapes, and forms. I've seen a 20-page term sheet. I've seen a 1-page term sheet. And typically, the information is the same. And essentially, you have your introduction that says, these are not binding terms. We're going to try and do a deal. And we're going to do a deal when the agreements are negotiated and executed by the 2 parties. And then you have this type of security here, the aggregate proceeds, $500,000, $1 million, $10 million. And then the purchasers, typically, with NMA Ventures, we'll say NMA Ventures and other investors approved by the company and the investor. And then you have your price per share. And then you have all the stuff, liquidation preferences, conversion, voting rights, documentation, financial information. So if you're a small investor, sometimes you don't get the information. If you're a larger investor, you actually get to information that is really pertinent to that particular company because you are a large investor. And then participation rights. Do I get to, if I own 2% and you guys are selling equity in the future, do I get to put more money in to keep my 2%? Your board of directors, your future rights, the key holders, they have to vest their stock over a period of time. What terms are binding and what terms are not binding? And then what's absent in this is the valuation. So what you would do is you'd have another line in here that says the pre-money valuation is X, the aggregate proceeds are Y, and then Z is your total. So that's essentially a preferred seeds share term sheet. And once again, I will be happy to share these with Cecilia after this deal. And then, let's see. Wrong one.
We had another question come in.
Sure.
What resources are available to us to perform a valuation of a company during startup? Like, are there consultants or companies who can do this early on when a startup is not yet making money, but have projections or pro forma forecasts?
So the answer is yes. What I would do is I would reach out to angel groups, and so that they could say, hey, I just want you to spend a half an hour with me at a coffee shop. Let me bring over my projections and my financials and my need for investment, and give me an idea what the valuation is. So Drew Tolchin is the New Mexico Angels president. You might want to reach out to him. The Albuquerque ID guy is TJ Cook, and he can help you. And I believe STC might be able to help you, or one of their mentors that has office hours. So the next term sheet is convertible notes. And once again, convertible notes are very easy because you don't have to do a lot of documentation. You don't have to change your articles of incorporation. You just create these notes and sell them and deal with all that paperwork later. And so once again, you have summary of principal terms of convertible shares. It's non-binding and solely for the purpose of coming together and negotiating definite agreements. Here's the issuer is XYZ Company, Fund 1, and current investors will be other improved investors. Going to buy $180,000 through issuance of Series A preferred stock convertible note. Let me write that in there. And then in this one, they gave warrants. So they gave a kicker so that investors would buy the convertible notes, and then they'd issue a warrants that said, okay, you can buy some Series A stock at a 11 cents for each issuance price of 77 cents. And then the valuation was $1.6 million. Capitalization would be on your cap table, closing date, board of directors. One director would be appointed by the fund, and the other two directors were identified. And then the use of funds would be approved by the board. And in this one, they actually described what the Series A would be that you would be converting into in the future. So you have dividends, liquidation preference, you have the conversion, you have anti-dilution, voting rights, protective provisions, drag-along rights, first right of refusal. So even in a convertible note term sheet, sometimes you articulate what you're converting to in the future. And once again, I'll clean that up and get it over to Cecilia. So if you need some information about that, I'd be happy to provide it. So thank you all so much for the time. More than willing to answer questions. So thank you so much. Do we have any questions?
Yeah, you have different valuation formulas out there. I got into the meeting a little bit late. did you provide some of those valuation formulas, or, you know, future sales, the market is 1.6 million factories in Texas and California alone, and each of them can use 10 of these units that we're projecting to build.
Mm-hmm.
And that's a future market.
Correct.
And then also the 2.2 million farms in the United States can use these for irrigating water, and they're solar, and they can use them for compressed air pumps, etc. So you got your valuation, but in Africa, you know, there's 400 million, and there's World Bank money being given to all these countries right now that could actually buy this and install this kind of system.
Uh-huh.
So it's huge. Okay, so that's the point. How do you value something like that?
So you look at the future and you work your way backwards. Okay.
Okay.
Is the product created, or is it still in proof of concept?
Proof of concept is done. We're in the process of building the next prototype.
Yep. Then what you would look at is, so think about going to market. How are you going to do that? Your go-to-market strategy. I mean, I appreciate that everybody thinks their product is easily sellable. It's hard to sell stuff in the marketplace. I mean, there can be tons of money, but you still have to go through a valuation process. You have to find the right person to sell to, and then you have to implement it. So it takes a lot. The concept with startups, and more than me can say this, it takes a lot more money and a lot more time to be successful. It's just the nature of the beast. Because if you have a product that is going into the marketplace, is it replacing something? Is it enhancing something? Is it doing something that's never done before? And so all those things have to come in what I would call a marketing plan to go to market, so that you can't just push it out and think everybody's going to buy. You're going to say, we're going to test market in New Mexico and see how many we sell. And then if we have good success, we'll go to Texas and see how it goes there. One of our companies that we work with, they have a product on market, and guess what happened? They couldn't get any of them. They sold too quickly. So for a month and a half, they had nothing to sell. So they didn't gauge the market correctly, that they were going to make all these sales. So they sold it all, and then, you know, we're begging the producers to make more of it. So it's really a function of looking at the market, looking at your go-to-market strategy, and then how are you going to sell your sales strategy? And then you can work your way back to evaluation. Any other questions?
I got a question.
Francisco.
Did you say earlier that an investor will ask for typically ask for like a 400% interest rate because they took a risk on investing?
No.
Okay.
So investors, there's two things. Do your due diligence on your investors, okay? Do a background check, do a New Mexico courts thing, talk to other companies that they've invested in, so that you have a good partner, right? So from an investor perspective, a typical angel deal or early stage deal, you're gonna sell 15 to 22% of your company, right? If someone says we want 61% of your company, try and find somebody else, because investors bet on the people that have created the company and the technology and the passion that they have. If someone says we want 400% interest, go to a bank or put money on your credit card at 20%. You don't need to pay it.
Okay.
Find the right partner that makes economic sense for you as a founder, vis-a-vis them putting resources behind you in a way that makes sense. The other So never said 400% interest, wouldn't ask that for anybody. So once again, find a financial partner either through your contacts or through the angels or through stc.unm and try and put together your pitch and your company that makes economic sense for you, but also makes economic sense for the investor.
Mhm. I have another question.
Sure.
Were you saying that some investors will, for startups, ask for a return on their investment, but they will not ask for equity in the company or stock until it has kind of proven itself, and then they'll ask for equity after the company or stock after it grows?
No. So an investor is not going to ask for a return. Okay. So I'll put money in and I'll expect to make 10 times my money, right? But if I don't make 10 times my money, I'm not going to go back to you and as an individual and say, you owe me the other 99% that I didn't get. So investors are investing in you as an individual and your company and your passion, and they're going to put resources behind you and try and help you. Okay. They can't demand anything because they can't see the future. And if they say they can see their future, then why are they investing in small companies? Why don't they just go to the public markets? So once again, it's all about structuring a deal that makes economic sense for you and economic sense for the investor, so that in the future, both of you benefit by them providing resources to you and your company.
Mhm.
Any more questions?
Yeah, I could hold you here all night. I'm in Germany, so I can't.
I do have a 4:30 another presentation. So
No, it's 12:30 here at night, but
There's
Yeah.
2 more questions in the chat, John.
okay,
yep, I'll hold off.
Okay, let's see.
From Jack Lavelle and Craig
What happens
Davidson.
I'll read it. What happens in a C Corp before the first outside investment where the founder employee shareholders already have vested a portion of their options that were granted to them? How do the first invest? So sometimes they'll ask you to recap your company, but if you've created some value, you should own that value, right? So they may split it up to where, okay, you own 60% of the company, so we're going to give you 25% upfront and then invest it over the next 2 years. It's not a big deal at all. And then the next question is from Craig. Let's say you have 2 markets for the same technology, and a larger one you cannot self-fund, but with larger, how do you choose? That's not a really, this is what I would do. I would go to market and prove that it actually works. And then once you prove that, you can now go to the investors and say, look, this thing works in this smaller market. Give me $10 million to take it to the larger market. One of the things that investors will sometimes say with really cool technology is focus on a particular problem that the marketplace has, solve that with the resources that you can get from an early seed round, and then Katie bar the door, because the investors will come to you because they like to see success. So we're going to leave it at that. I want to thank everyone for coming. If I'll send Cecilia the term sheets and the deck. And once again, thank you so much for your time today. We appreciate it. Have a great day.
Thank you, everybody. Have a good evening.
Thank you.
Thank you, John.